Hello and welcome to my morning note. Over in Washington, the FOMC is about to meet and the consensus is really quite overwhelming following Friday's insipid unemployment data that they are going to announce some form of QE3, another round of big bond purchases designed to push down bond yields. The situation is really quite different from QE1 and QE2. Unlike those times, at the moment, the stock market is doing well and inflation expectations are actually going up rather than down. So what exactly is going on and what is the Fed going to do? With me now to discuss this, joining us from New York, is the Chief Foreign Exchange Strategist at Brown Brothers Harriman, Marc Chandler. Marc, thank you very much for joining us today. We'll have a quick look at this as a chart that shows the S&P stock index compared to jobless claims, and it doesn't appear to show that anything is running too terribly badly with the US economy just at the moment. Does the economy really need another jolt of stimulus?
Well, I think this is the unusual thing here. As we speak here, the U.S. economy is growing around 2%. Inflation is around 2%. The unemployment rate is just above 8%. These kind of numbers are not the kind of numbers that one would expect a central bank to have to do unconventional means to stimulate the economy. These kind of economic numbers, 2% growth, 2% inflation, I would say the envy of most of the G10 high-income countries. So it seems a bit unusual, but I think what the Federal Reserve says is that while this might be good for the rest of the world, this just isn't good enough for Americans. The economy is growing too slowly to bring down that unemployment rate faster, and they want to do that.
Now, on unemployment, though, despite the general perception that President Obama has been a big government liberal, if we take a look at a chart of how jobs have changed in the private sector compared to the government sector, and this is a point you've made yourself, the problem with this recovery is that there's been a loss of government jobs, whereas the private sector doesn't seem to be doing so badly. And is there something that the Fed can even do about government jobs?
Yeah, it seems to me quite the opposite. I think it seems to me that what's happening is that the state governments and local governments in the U.S., especially the state governments, have balanced budgets in their constitutions. And so they are forced to cut back. So as much as it might seem like Washington, D.C., President Obama spent money, the state and local governments cut back even further. And so I think that's what you're really finding with this decline in the employment sector, employment in the government sector, is really state and local workers have lost their jobs. And this is one way, and this one of the reasons why this recovery is really jobless. Not so much because of the private sector. It's true the private sector, we all hoped the private sector would add jobs quicker. It hadn't, but it has added a lot of jobs. It's really the government sector cutbacks that are making this recovery unique compared to the past several recoveries we've had.
Now, let's ask for many people, what will matter most about QE, if we have more QE, is the effect that it'll have on the dollar. We're taking a look at a very long-term chart here, and you can see that the dollar, taking the long view, has been extremely weak for a long time. You would assume that QE3 would push it back down further once more. What's your perspective on where the dollar is heading?
Yes, well, first I'd say that I understand the economic theory behind QE weighing on a currency, but I look at a number of countries that are pursuing QE, and they've got strong currencies, like the Japanese yen, like the British pound. I'd say those countries are pursuing quantitative easing, and those currencies are strong. It seems to me the dollar, what you show there, is a broad trade-weighted measure of the dollar, which picks up a lot of emerging market countries as well. But for me, I would say that the dollar has done much better against the euro, for example, peaked at over $1.60 back in 2008. As your chart shows, the dollar foreign exchange market tends to trend for many years at a time. And I think a bull market for the dollar actually began in 2008. And I think that you're right that in the short run, we've seen the dollar set back as different events happening in Europe. But I think the dollar is going to still come back strong after quantitative easing is announced. This is what's happened in the past QE1, QE2. The dollar sells off before the fact and then rallies afterwards. And I think the same thing's going to happen this time. And
it's sold off by about 5% against the trade-weighted basket in the last 5 or 6 weeks. One final question. What if we do get a Fed surprise here and we don't get a significant new round of asset purchases? What kind of effect do you think that has on the markets?
Sure, I think they'd have a conflicting impulse on the market if the Fed disappoints the market with not doing quantitative easing. I think that some of the rally in the stock market has been prompted by expectations of quantitative easing. So I think that there would be a risk-off trade, which would be net positive for the dollar, probably net negative for the stock market, and probably net negative for the euro and Australian dollar and other risk-on type of currencies.
Okay, Mark, thank you very much indeed.
Thank you.
I think the main takeaway is that we should expect, we've had all the signals, we should expect that we're going to get QE3 or something very much like it. There has to be very many questions about whether it's truly necessary just at the moment.